The Bito ETF, officially known as the ProShares Bitcoin Strategy ETF, is one of the first Bitcoin-related exchange-traded funds, ETFs, available for investors in the United States. It offers a way to gain exposure to Bitcoin without directly buying or holding the cryptocurrency. Let's break it down simply and understand how it works. What is Bito ETF? Bito is a futures-based ETF, which means it doesn't invest in actual Bitcoin. Instead, it invests in Bitcoin futures contracts. A Bitcoin futures contract is an agreement to buy or sell Bitcoin at a set price on a future date. These contracts allow Bito to track Bitcoin's price movements indirectly, but not perfectly. Because Bito uses futures, its performance may not exactly match Bitcoin's price. This is due to something called contango, where futures prices are higher than the current price of Bitcoin. Over time, this can create a slight drag on returns compared to owning Bitcoin directly. Why invest in Bito? Bito is designed for investors who want exposure to Bitcoin but prefer to do so within the traditional financial system. Here are a few reasons someone might choose Bito over directly buying Bitcoin. No need for a crypto wallet. When you buy Bitcoin, you need a digital wallet to store it securely. With Bito, you don't need to worry about managing wallets, private keys, or security risks like hacking. Ease of access. Bito is traded on the New York Stock Exchange, just like any other stock or ETF. You can buy and sell shares through your regular brokerage account, making it much more accessible than dealing with cryptocurrency exchanges. Regulation and security. Bito operates within the regulated stock market, providing an added layer of trust for traditional investors who may be wary of the unregulated nature of cryptocurrencies. Example of Bito in action. Imagine Bitcoin's price is $20,000. If you believe Bitcoin's price will rise, but don't want to deal with buying and holding the actual cryptocurrency, you can invest in Bito instead. Let's say you buy $1,000 worth of Bito shares. If Bitcoin's price goes up by 10%, Bito's price is likely to rise as well, giving you a similar return, though not exactly 10% due to the futures-based structure. However, if Bitcoin's price drops, Bito will also lose value, reflecting that price decline. The key difference is you're trading a stock-like asset instead of actual Bitcoin. Advantages of Bito. No direct exposure to Bitcoin. You're not holding Bitcoin itself, which eliminates concerns about storage, security, or losing access to your funds. Tax efficiency. For U.S. investors, buying and selling Bito may have more favorable tax treatment than trading Bitcoin directly, depending on your situation. Diversification. You can include Bito in a diversified investment portfolio alongside other stocks and ETFs. Disadvantages of Bito. Futures contracts can add costs. Because Bito invests in futures, there are ongoing costs to roll over contracts as they expire. These costs can reduce your returns over time. Tracking differences. Bito's price might not perfectly match Bitcoin's price due to the way futures work. This is something to consider if you're looking for exact one-to-one performance. Short-term focus. Bito is better suited for short to medium-term exposure to Bitcoin. For long-term investors, the tracking differences and costs may become more significant. Is Bito right for you? Bito is ideal for investors who want a convenient and regulated way to gain exposure to Bitcoin without diving into the cryptocurrency world directly. However, it's not a perfect substitute for holding Bitcoin itself, especially if you're a long-term believer in the cryptocurrency. Understanding how Bito works can help you decide if it fits your investment strategy. Whether you're a crypto enthusiast or a cautious traditional investor, Bito provides an interesting way to explore the world of Bitcoin.